Ladies and gentlemen, it is now time to announce our first panel discussion on the topic Emerging Opportunities in Climate Lending. And to moderate the session, may I invite Shri Anirudh Marathe, Managing Director and Partner, BCG, on the dais. I take pleasure in inviting the panel of speakers to the dais. Shri Manish Chaurasia, MD, Tata Cleantech Capital. Shri Upendra Bhatt, Managing Director, C Kinetics. We have Shri Manish Chaurasia, MD, Tata Cleantech Capital. Shri Upendra Bhatt, Managing Director, C Kinetics. Request you to please come on the stage, sir. Ms. Anjali Bansal, Founding Partner, Avana Capital. Can we have you on the stage, ma'am, please?
Good afternoon, everyone. It's a real pleasure to be among all the dignitaries today on the dais and also in the audience. It's a very power-packed set of gathering with very senior leaders of the industry here. I will start with a small anecdote. A couple of years ago, I was in a board meeting where the board was discussing about setting targets for the next year and the 3-year strategic roadmap and aspiration. There was a lot of discussion where people were making very bold statements in terms of what they will achieve in 3 years. But there was relatively not so much of a discussion on the next year's target. After some time, the chairman of the board got up and said that, ladies and gentlemen, let's just settle down a little bit. I'm okay if you reduce your aspirations but increase your targets. So, taking the cue from what Mr. Raman said towards the end of the conversation that Ashish just had with him, what gets measured is what will practically happen. To that extent, the focus of this panel will be on the near-term opportunities. What do we see, not necessarily obviously in 1 year, but maybe in the immediate term. What is the reality of this market today? What is the situation on ground? And then therefore, what do we can really see happening in the next 2-3 years, which is obviously going to be relevant for the audience which is sitting here. All of you are practitioners. And for you, it is important to understand what is it that we should look out for in the immediate future. Manish, let me start with you. Just as a context setting, what do you see is the nature of the climate finance in India today in terms of, let's say, the sector mix, the product mix? And if you could just give a small backdrop in terms of how you have come here.
So, today, if we I'm audible? Yeah. So essentially, the sectors you can divide into 2 major buckets, and one's maybe a small bucket. So first bucket is clearly projects which lead to decarbonization, which is renewable energy, solar, wind, small hydro. Then the second, and most of the progress we have seen is along this dimension. The second bucket would be projects which lead to energy efficiency. So this would mean, say, electric vehicles, say, smart meters used by the DISCOMs, or it could mean, energy efficient lighting, or energy efficient equipments in industries. So that's a second important bucket. Third bucket is which it's kind of a transition, sectors, which don't really lead to decarbonization, but they still help in reduction of pollution. Like, say, waste to energy. We spoke about compressed gas, biogas, and so on and so forth. So investments have happened along all these 3 dimensions. If you see India, starting from, I would say, 2011-12, we have seen major investments in renewable energy. And I think over the last 8 to 9 years, investments would have been about, say, 70 to 80 billion US dollars. But if you go to the next 7 or 8 years, then, if you really take into account the commitments which India has made through NDCs and some of the other ambitious projects which have been announced, then total investments will add to more than $1 trillion. So that's not a small change, that's a multiple of 15 to 16 times. So this is about the sectors. Then if you take in terms of the products, as has been spoken earlier also, most of the finances come to in this sector through lending, through loans. And most of the lending has happened through the banking system or through NBFCs. To some extent, we have seen money coming through international bond market, which is green bonds. But that is small, that won't be more than 10 to 15% of the total funding which has come. The other way in which the major funding has come is through the equity. And that equity has been through various private equity players. The sovereign wealth funds have invested in India. A lot of other players have invested, who are into oil sectors, and some of the entrepreneurs have come in, who are already a big industrial houses in India. So overall, we have seen that most of the money has come through the banking system, to some extent through bond market, and of course, the equity has to come in, and which has come, that is where we have seen a lot of foreign participation through the private equity firms. So that is what I would say is the brief summary here.
Anjali, when you and I were speaking before the panel, you said that, when we discuss about climate finance, we should start immediately beyond solar and renewable, which is already in a way a known, market demand and known established product construct. What do you really see as the emerging demand areas? Where will the credit flow, let's say in the next, 3 to 5 years? Which are the big emerging opportunities beyond solar and renewables that you see?
Anirudh, if you permit, I will rephrase that question.
Sure.
Where not will credit flow, because unfortunately it is not flowing. Where should credit flow? So today, solar renewable, particularly at utility scale and CNI, is, yes, of course it is green energy, but it is no longer frontier and it is no longer developmental. Right? So it is now mainstream. It's actually, it makes eminent sense for any company to take on solar or hybrid power instead of the traditional thermal. It's cheaper and it is a lot more efficient. So that period, and then there is plenty of commercial capital. So I suspect a lot of credit will continue to flow. Where will it flow? It will continue to flow into renewable, solar, utility and CNI. Where it needs to flow is on rooftop. For residential, for MSME, we've had in the last 9 years some 5 lakh rooftop installations. That is not enough. To really solarize India, we need to get solar and other forms of renewable into MSME clusters, which still do not have access. And the reason for that, of course, is technology, and I'll come to technology in a minute, but is financing access. So the ability for these small businesses, residential, and particularly let's focus on small businesses. We were listening to Chairman Raman just before this. For them to access finance is still at prohibitively high rates. So it's 18, 20, 24% rates. That needs to come down to 8 to 10% asset-backed financing. So those products need to get created. Banks need to work on it, NBFCs need to work on it, and more blended finance needs to come into play here. So that's one piece. The other pieces are a lot of frontier needs to happen on waste management, circularity, new fuels, biofuels, grid scale storage, which is largely non-existent today, but BESS is now starting to happen, battery energy storage systems. And this is still only energy. Now if we start talking about circular economy, alternative materials, plastic alternatives, agriculture, new ways of producing food that are fundamentally more climate resilient when it comes to water, as well as energy usage, I think there's a whole other spectrum of understanding skill sets, capacities that will get created hopefully in the financing space, and consequently products and market linkages.
Interesting. Vendra, I'll come to you. Anjali talked about different areas and many, many different areas. She talked about rooftop solar, she talked about battery, she talked about some of the other elements around, going beyond just the energy. What do you think is the real opportunity as you see emerging, where we see acceleration in the, in the near term, or which of this will perhaps stay as a hype or not so practical opportunity in the near term? And after you, I'll take that from the other panelists as well.
Well, I think the starting point on this is this obviously different players in the market looking at it differently. They are in different stages. So there are venture, and therefore the venture financing and credit in context of venture has a very different meaning than an existing business, whether it's an SME or otherwise. Having said that, let me start from the question you asked, right? I think the 4 or 5 segments which are certainly going to scale up, right? One is distributed solar, and I think that is going to pick up significantly in the next 3 years. I think you're seeing early shoots of that even now in small residential, which wasn't the case 2 years back. Nothing primarily has changed the policy regulatory phase, but I think it's just much closer to the tipping point, and therefore it will go. I think all the economic levers are all in place. So I think that's there. I think the small cargo vehicle financing will pick up, and I don't think it may necessarily be bank-led. Banks will play a role, perhaps do more co-lending. SIDBI has come up with some interesting programs. But it will be NBFC-led, because even in the conventional vehicle space, if you look at it, those segments are NBFC or captive NBFC or regional NBFC-led. So I think you will see significant scale there. The third one, which you will start seeing early shoots but may not be, is the battery storages. But I think we are about 24 months away, in my view, 24 to 36 months away on that. But I think you will start seeing some momentum. See, I think credit will flow, particularly from the large banks once there is significant pipeline in place. They want to dumb down the loan product. They don't want their loan officers to apply mind of doing a project financing. That competence doesn't exist, and we can talk about all the knowledge enhancement, but I think the mechanisms are geared that way. So we have to get it to a product financing rather than a project financing for that subscale. So I think these 4 segments, the ones which I see will continue playing in the venture credit space will be waste to energy, and because there I think it is both a question of technologies getting settled. A lot of circularity models are getting set up. A lot of companies managing, plastic waste in a different way, fuel, plastic to fuel in a different way, because of mandates from several large global majors. But I don't think any one of them still is at a form and shape. I'm not now talking company, but the technology or the solution, which is, closer to being productized. So I don't see, I think credit is needed. I think you will see some cash flow financing happening for that. But I don't think it will get to a form of an asset financing structure in 24 months, if that's a window we are looking at.
How about hydrogen? I mean, there is a lot of talk about hydrogen, gray, blue, green.
Can I just make a quick comment
sure,
on hydrogen?
please.
I think we need to differentiate between large-scale project finance, where a lot of things can be brought to bear, versus, ticket sizes that the typical banking loans are talking about. And I think that's the big delta in my view. Even grid-connected storage, chances are you will see some projects going through. It's not, pump storage is not a new technology in India. I did a pump storage program 20 years back. Purulia pump storage was the largest. It was backed by a Japanese funding line at that point. So I think we should, so I think some of these initial projects may go through, but I don't see that as a technology at scale for next 5 to 6 years. I personally don't see that. I don't know, keen to hear Manisha's
Thoughts?
So yes, so clearly, as renewables scale up, the key issue would be the stability of the grid, because renewable is a informed power. Now, if we have to really make it scalable, then it is important that we find a solution in terms of energy storage. Now, that solution can come through battery storage, or it can come from pumped hydro, or it can come from green hydrogen. Today, if you really compare these 3 segments, and I think storage is a very important part of the whole debate. I think pumped storage is where, which happens at a much larger scale, but in terms of the cost, it is the lowest cost. But the issue is that you need proper sites. And government has already identified sites worth about 28 gigawatts. I think that segment will pick up, and already we are seeing some players who are getting active into this. So that's one thing about the storage. About the battery, the key issue would be that the technology is, while it is developed significantly, but there's an element of risk there, because right now we talk about lithium ion. Again, technologies are developing, aluminum air is coming, sodium ion is coming, and they have their own advantages. So there we'll have to see how the technology stabilizes, but clearly for, say, electric vehicles and all, that will be the technology. Then coming to green hydrogen. Green hydrogen, in terms of the macro reality, has big benefits. Because when you talk about the battery, you are constrained by the availability of rare earth metals. And if you talk about the pumped hydro, you are constrained by the availability of suitable sites. Green hydrogen, while it is extremely important because water is there everywhere, and it is ultimately made from water. But the challenge is that today the cost is high. Today the cost is around $4 to $5 per unit. While if you take the gray hydrogen, it is probably less than $2. But then the important thing to remember is that this is what was the situation of solar power about a decade back. Decade back, solar power was at 18 to 90 rupees per unit of power. And because government gave some, infant industry incentives, and after that we saw that a lot of scale came into the sector, a lot of technological development happened. And now the cost of solar power has come down to 2 to 2 rupees per unit of power. In my view, while as Upendra rightly said that in next, say, 5 to 6 years, we probably may not see a huge scale in green hydrogen, but ultimately because of the incentives which, the governments will give it to this sector, we will eventually see that it comes up the curve. And eventually that will become most important for the energy storage. And there are reasons to believe that it will happen because, ultimately you make that green hydrogen through solar power. And solar power efficiencies are going up. The better modules are coming in the market. So efficiency, which used to be 14-15%, is likely to go up to 25-26%, which is a significant, improvement, 40-50% improvement. So because of that, because the cost of power will come down, cost of green hydrogen will come down. Secondly, as scale comes into the sector, the cost of electrolyzers will come down. So clearly, I think the same journey will be there, but it will take time.
Anjali, as you answer with your comments, just one more question that you can continue with. Where do you see the credit coming, or finance coming, equity? Which players are really active? Which players are really, need to do more than what they are doing right now, which are punching above the weight, below the weight as well?
I think as both Upendra and Manish have rightly said, we must think about this in different types of financing. There is large-scale project financing that will go into the billion-dollar capex required for hydrogen, for example. But at the same time, there will be innovation on electrolyzer technology that is smaller. It plays in the innovation space that is venture fundable potentially, and certainly will require capital and credit capital of different types. So let's break up the capital stack. Some things still require, say, philanthropic capital, right? Non-returnable capital that is not in the purview of lending or equity. Nature-based solutions and so on come into that space. You do need the early stage equity, the venture equity for supporting innovation. A lot more capital needs to come into that space across the spectrum. So again, not just energy. Climate cannot be, we are talking unlocking climate finance. Climate is not just energy. We have to think about emission footprints, and that will span supply chains and built environment and circular economy and agriculture also. Water, of course, important element. So you need equity for that. You need large-scale equity for large-scale projects. But there is a real dearth of credit. And working capital financing for less understood technologies, less mature technologies. Manish said 15 years ago in the first cycle of solar was completely subsidy dependent, right? So the market did not work. Today the market works, the technology cost curves have shifted. Moore's law is now applying to all elements of climate technology as well. It has happened in energy and solar, it will start happening in electrolyzers, it's already happened in sensors and hence IoT-led data devices, and consequently better decision making. That should lead, hence, to better data generation and more underwriting capability. So when you're able to underwrite, you're able to price the risk and then parse the risk to different kinds of actors in the ecosystem. And that is where you need development finance, blended finance, things like credit guarantees, first loss, and sometimes straight outright development or impact linked, outcome linked products as well. So actually we need the full stack. I think the commercial banking NBFC ecosystem is doing a reasonable job of sort of coming up to speed, and we heard, I think SIDBI is doing yeoman service as they did with microfinance, and they sort of kick-started the AIF ecosystem. They are doing the same thing with green finance now. But the MDBs, the larger development finance institutions, and bringing in some of the philanthropic capital into the space is also important.
I think that's a very wide gamut. Upendra, if I come to you on this, just the product side, I mean, Anjali mentioned credit guarantees, the data for underwriting. The biggest challenge that I see is that while these product constructs are needed, if we speak to bankers or investors, typically the response is that, look, this is a risk that we don't understand because there is no data, there is no precedent. And banking is not taking blind risk, right? Or financing is not taking blind risk, but informed risk. Obviously, it's a risk return trade-off that you do. While all these products are needed, what is the capability of the investors or financiers in India to really make it happen versus what we need to really get it from outside? Which of these products will really be feasible as we look at it?
I think, as Anjali said, that I think all of this is needed, right? And more. But if I go with the outlook on product creation, I think we are at a stage where increasingly it is felt that because bulk of this capital is going to only materialize from domestic sources, it is best to enhance that capacity domestically, right? And you have large pools of capital which have still not been steered, insurance or pension funds, etc., in this space at all. So the best way it's seeing it is a blend of credit pools but also credit enhancement pools. So far, outside of CGT SME, which has been one of the largest facilities for mid-sized guys, IIFCL run a guarantee for a few things. We haven't necessarily had large facility scaler for newer segments or newer technologies. Now we are getting with very, I would say, segment specific. We have seen, we jointly with Climate Policy Initiative built out a scheme for one of the DFIs, which is now getting, focused on in context of rooftop. And I think the starting point on this, Anirudh, really is taking a view on the off-taker credit, historical off-taker performance, and building it off that. So you'll have to do a transition matrix. Part of the problem is many of the credit products for off-takers have never been more than 5 years, 7 years at best. And now you're saying, I want to give a rooftop loan for 10 years or 15 years. How do you price it? So there's a little bit of information asymmetry but there are ways to plug it and build off that. Question would be how much leverage you want to seek of those credit enhancement pools, and I think one has to be modest while building it out. Lot of global philanthropic capital is not necessarily looking for leverage initially. What they want is the domestic capacities to go in. So that's one piece, right? The second piece on this, I think, is what kind of risks get covered by this. I think that's where you need to also divvy up. So if you're looking at electric mobility, credit risk will be very different than technology risk. So is there a role and opportunity for an attachment solution coming from the manufacturers? Because many of the manufacturers are new. Again, from our work on the investment advisory side, we are just helping craft out a product for a very large private sector DFI to build this out for the manufacturers in the space. And I think it will make some difference in the manner, because many of these guys, when they go to NBFCs to finance their clients, they ask them for an attachment because your balance sheets don't have the multi-year history. So how do you, so I think one has to kind of factor in those nuances while building this out. And I think the last bit on product innovation, Anirudh, really is about that how do you capture the data and how effectively do you then incorporate this into product intensification becomes key. Even today, if I go, despite all the conversation we are having on solar or rooftop having been centralized, our yields on rooftop solar are far lower than what the models present, right? And so anecdotally people are, so you could have a systemic risk brewing when you go from 5 lakh installations to, let's say, 50 million installations, because you are going to build up an X amount of building stock in the years ahead. So I think that's the whole focus on data capture and data intensification is key. Because it's not just about default because the person has run away. It's about the technology not having performed, but technically the module is performing, inverter is performing. It's just the environment in which it is being. So I think some of these nuances are critical for that product innovation.
Manish, if I, switch this to the borrower perspective or, the receiver of this investment, their perspective. On one hand, we see that there are many, let's say, large corporate, very high quality credit, AAA rated, issuers or borrowers. They get credit or financing a lot more easily, either because of their balance sheet or because of their, history, etc. Whereas many other who are coming into this field, many MSMEs will obviously find it very difficult. How do you see the borrowers looking at this? What is their reaction to what kind of products that are available? What is it that they think that should be made available, which they currently don't get?
Okay, yeah, it's a very pertinent question. So let's divide this into two segments. First segment would be, borrowing for those segments, which is in the money. If you see the entire requirement of funds for the climate finance, at least 2/3 of this is in the money. In the money meaning that basically the sector is viable, like say solar, wind, small hydro. But then you need a proper project enforcement framework. So as long as contract enforcement is proper, as long as off-takers are strong, the projects are viable. Now for these kind of projects, it is important to remember that capital costs are very high, but the operating costs are extremely low because, there is no raw material, everything is nature. And this capital cost is essentially funded through debt and equity. So naturally, debt is a major portion of this. And that's why the most important thing for the borrower is the cost of this debt. And even, a 50 or 100 basis point makes a huge difference, because if you are funding something with 3 debt and 1 equity, then 100 basis point reduction in cost means almost 300 basis point improvement in return on equity. So clearly the most important thing for the borrower is the cost of this debt. And for the cost of the debt to come down, we have to remember that it's a function of 2-3 factors. One is the real interest rates, other is the inflation, and third is the risk in the project. Now, real interest rates and inflation is something which is the macroeconomic issue. So what can be only controlled is the risk in the project. And that risk to a great extent is decided by the quality of the off-taker. So as long as, and in the Indian context, most of the time that off-taker is a public institution. So I think most important thing is to improve the health of the public institutions, so that they are very sure that if they are selling power to a DISCOM, or if they are providing services to a state transport utility, they will get paid in time. I think that is the step number 1, which is the most important factor. The second is the tenor of this debt. Most of these technologies are so capital intensive that you require a debt of 15-20 years to actually make the projects viable. Now, if you have to give that long-term debt, then actually the banking system doesn't have money which is so long-term. But then there are easy solutions to that. What is happening today is that when the projects are under construction, then they are funded through a debt which is on paper long-term, but eventually it gets refinanced. And eventually these projects get refinanced after a couple of years, and then a lot of these projects are aggregated. And then some credit enhancement happens so that the cost of debt comes down significantly. So I think that is something which is working well, provided the contracts are enforced and provided the quality of off-takers are good. Then you come to the second bucket, which is 1/3, and which is where you need actual subsidies. And this would be projects in, say, green hydrogen sector, or sometimes even say, the waste to energy, or sometimes even, around the clock power, where you would require energy storage, battery storage. Now in these kind of sectors, you need long-term contracts which are backed by the government, and you require in-kind government subsidies. If we can have that framework right, which we got for solar, and it had its own issues. Ultimately, SECI came in as an off-taker and the issues got resolved. So as long as we can have a contract enforcement which is strong, I think the capital will come. And probably it will be a mix of various capitals. And going forward, one significant development which will happen is that the carbon market will develop. So the source of revenue itself will go up. And that would itself mean that capital will become cheaper. Yeah. So that is what I would like to say on this. Yeah. And it is important to remember that philanthropic capital on this will not be very high. Because the availability is very low. Yeah.
Anjali, a follow-up question to you more on the equity side of it, right? As you look at different projects, different borrowers or companies which are seeking investment, what is it that you see? What is the typical profile? Do you see these to be really reliable kind of players who really know their business, or there are large corporate? What kind of borrower mix or investor mix do you really see in the market, and how will that change?
So at Avana, we are early stage technology investors. So
sure, I mean,
right, so let me give the Avana view, and then I'll give the industry.
For the broader market as well.
Yeah. So we see about 800 to 1,000 opportunities every year.
That's a large number.
That's a very large number, which is why one is very optimistic that when you have these high quality founders who are now deciding to build and solve for climate versus fintech and internet, consumer internet and so on, this problem will get solved, right? So climate action, climate change as a problem will get solved when you have this quality of young talent going into it with a view to solving the problem. We go in early. So we take, obviously we are taking equity risk and early stage equity risk, both on technology. So it's, we don't do lab stage technology, we do TRL level 5 and beyond, but commercialized or commercializing technology is the risk we take. Across the spectrum, I think if you look at climate borrowers, today climate and sustainability is not a separate vertical in most companies. We are where we were, say, 25, 30 years ago on digital. So 30 years ago when I started in business, companies didn't have a digital sense at all. They barely had a CTO. Today, digitalization is embedded as a horizontal across the enterprise. Similarly, sustainabilization will get embedded across the enterprise in every function. Product design, supply chain, sourcing, manufacturing, distribution, and it will fundamentally change how we live, work, and interact with each other. Right? So the scale and scope of this opportunity, this problem is huge, but the opportunity is also huge. Consequently, there will, again, rewind 15 years ago, the first cycle of clean tech, it required subsidies. Subsidies are important to catalyze adoption and bring in supply capacities into the market, and consequently lead to further innovation and bringing cost curves down. This has happened with solar, this has happened, now we are seeing it with EV. EV adoption really took off after FAME 2. We are seeing PLI now come into solar manufacturing, into hydrogen. So I think all of that will catalyze. But beyond that, for projects to become credit worthy, corporates will get their fair share of credit. I sit on the board of Tata Power, for example. So there's no dearth of capital for Tata Group companies, right, Manish? So high quality, large corporates will get capital which is linked to their credit worthiness. The gap in the market is for new emerging technologies, consequently new emerging business models, and say SMEs, call them small businesses, call them startups, where today actually there is no working capital. There is barely any revenue-based financing because the underwriting models don't exist, because the data models don't exist. And as you rightly said, banks and NBFCs and lenders are not in the business of giving money away. They have to underwrite, price the risk and get it back.
Yes.
So that is actually where the big gap is, and I would say, since we are at an IBA forum, frankly that is where the opportunity is. Whoever cracks this will get a fair share of more than their fair share of the market.
Very well. We talked about a little bit in terms of the demand side, where what sectors, what products. We talked about the supply side as well in terms of what kind of finances, what kind of finance and the product. In this entire conversation, all of you talked about a lot of things which are dependent on government or other third-party elements. There are many enablers that are required. And it's a long list. I mean, we talked about international finance flow, we talked about MDBs doing their job, we talked about government giving subsidies, government creating frameworks, industry bodies doing things, a lot of things. So Upendra, I'll come to you in terms of, if you were to pick top 3, in terms of the urgency and importance of these enablers, which are the top 3, 4 that you think, in the pecking order are the most important?
Yeah, Anirudh, I'll just quickly respond to that. But before that, I just wanted to comment on a point that Anjali made around people not willing to go into revenue-oriented cash flow models. Our financing arm, actually, Seekers Finance, does that and does it quite effectively. We are perhaps amongst the few people in the marketplace who perhaps are the first lender in most cases. We work with them to set up these benchmarks. Many of them actually become much larger than what our balance sheet allows us to support over a period of time. So there is a method to madness, and that leads to, why are we able to do it, or how are we able to do it? One is, of course, our intent and understanding of technologies. That comes from the knowledge management side. So when we are looking at ecosystem enablers, Anirudh, I look at 3 things which I think are absolutely critical if we expect credit to flow at a much... See, one is, in a decade's time, a lot of the segments we are talking credit will be flowing. Right or wrong, we will get there. Question is, do we get to that faster or later?
Yeah,
right?
the urgency is important.
Right. Well, yes and no. I mean, if India's pace is going to decide the climate future, then right. But the 3 things in our experience, again, one, I think, is just a comprehensive knowledge pool on technology options and what they mean. Because when people are investing in these models, they are very worried currently that are these likely to be transient in nature? And would I end up moving from one asset where I'm being pointed out that I'll be locked in versus... So what technologies and what is the life cycle, and would I be given enough time to enter and exit becomes a big consideration, right? A good point in case is we were never able to define a paging industry use case in India just within the time frame when it came, and a lot of investment was lost, right? The second thing on this, I think, is the credit enhancement pools, where I think there is an opportunity for the government and partnerships with DFIs. And I think the best use of philanthropic capital in India, barring maybe some adaptation-oriented projects for mitigation in particular, I think should only be our credit enhancement pool, because I think we have a fairly evolved market otherwise. It's not that, you take a segment to Manisha's team that they will not be able to finance it, provided they get these elements. And I think third is the constant demand and a pipeline of projects, because what we see is sometimes, and again, if we take FAME as an example, we came with FAME 1, we went through a hype cycle, came down FAME 2, we went through, last year we went into some other issues around manufacturing, etc., etc. So I think demand is a critical component. Again, I think for some of the segments, government will be the demand creator. So I see these 3 as critical. Wherever government is not creating demand, I think it's opportunity for catalysts and banks to come together and foster programs and outreach programs to enhance that.
Anjali, do you agree with these top 3?
No, I agree. Actually, as has been rightly said earlier in this session, everything is needed.
Yeah,
so
but
there is no disagreement.
Yeah, everything is needed is not, everybody...
So you are saying prioritize it, right?
Prioritization
okay,
is
so let's
important.
prioritize. And by the way, I think the work that Upendra and team are doing at Seekers is absolutely exemplary, and we need to multiply that like 20x, if not 200x. So we need more. We need more. So how do you get markets to work? So that this dependence on subsidy or development capital or risk mitigation is short and not long, and it plays the role it is meant to play, which is that of catalyzing. Policy can help to catalyze demand, which I think is a great role for policy to play. is catalyze demand. So let's take an example, right? So because policy mandated doing away with single-use plastic, it led to behavior change, consequently led to corporate behavior change. Consumer behavior change leading to corporate behavior change. EPR rules for whether plastics or electronics are leading to new business models getting developed, right? So your waste management is now getting organized, formalized, and technologized. Earlier it didn't make sense to apply technology. Now we continuously see a stream of startups that are saying, or by the way, not just startups, actually mid-sized companies that are developing computer vision aided technology for segregation at scale, for taking MLP and putting it, sort of recycling it, reducing it and putting it back into the production cycle. So policy will play a big role in stimulating demand because they will mandate certain things, which is terrific. But policy can also play a role in catalyzing supply by creating subsidies, by credit guarantee schemes and so on. How do we bring in the large scale commercialization that will actually make it mainstream? That is really what I think as large scale banks, NBFCs, the big lending sector and the big financial sector, and we haven't talked insurance yet. Parametric insurance is a big gap. Once that comes in, and why is it not there? Because data models don't exist. So you do come around to an understanding of technologies, capacity building, and I mean capability building or understanding of those technologies, underwriting, hence data models, a common taxonomy, so that everyone's speaking the same language. When we say green, what does it mean? Is it green? Is it brown? The other big missing area completely right now, which large global capital, particularly DFI mandated climate capital is not coming into, is the brownfield, so the brown to green transition. There is still a lot of hesitation to fund the brown to green transition because the taxonomy and the underwriting models aren't there. And everyone's super sensitive right now internationally of being accused of greenwashing.
Manish, you know, we as an industry obviously ask many of these things from the government, from international forums, etc. This room here, the industry, what kind of initiatives can happen at the industry level, what we can do to accelerate creation of these enablers? I mean, she talked about data, right? Nobody is going to create data, right? Unless there is some initiative to start figuring out a way to capture the metrics, build some, taxonomies can come and go, but, ultimately all taxonomies are dependent on the measurement, right? What is it that the industry can do to accelerate creation of these enablers?
So yes, if we are able to create demand, as Upendra spoke about, and if we are able to create the supply through policy level change, as Anjali spoke about, then clearly you can get the market forces acting. Now, if I see our experience over the last few years, I think one important message for the industry would be that industry has to behave responsibly. I'll give you an example of that. See, what we have seen in the past is 2-3 issues. One, Anjali spoke about greenwashing. That is number one. Number two is that most of these investments have happened through contracts, correct? So, you have got bids which come out from the government, auctions which come out, and the industry bids. In the past, we have seen that quite a few times, the bidding has been quite irrational, in the sense that it has been more of a speculative bidding. It is based on the fact that they will imagine that the cost of modules will come down, they will be able to borrow at a X rate or Y rate, and that's why they bid very low. Why do they do that? Because they want to grab capacities. Why do they want to grab capacities? Because there is an agency issue. They have already raised money from a private equity or from a sovereign wealth fund, and now they have to somehow deploy. So that leads to irrational behavior, and I think that needs to change, because in India we have seen that while we talk about some 80 or 90 gigawatts of projects under construction, but actually what you are seeing on the ground is only 10 to 15 gigawatts per annum. So clearly what's happening is that the bidding has been irrational, and if they find that the cost of the materials, modules and cost of financing is not as per their satisfaction, then they don't implement the project. So one is that industry has to behave responsibly, because once they do that, then we can see more, then they can also give feedback to the government as to what is going wrong, how the contracts need to be modified, and then more capacities will come in. And the other is that if you talk about industries in general, now clean tech is horizontal. Every company has to do clean tech, circular economy, decarbonization. So first thing they have to do is have proper measurements, where again SEBI is taking a role, BRSR, that's the initiative towards it. Have a proper measurement, number one. And number two, after you measure it, then you will monitor it. And never get into the temptation of greenwashing. Because we are seeing today that, so many people are claiming they are net zero, but that's not adding to the environment. So clearly greenwashing is happening. So basically greenwashing, number one, and number two is behaving responsibly in auctions.
I think that's a very, very pertinent point. I think it was a very good discussion, interacting with all of you, very different perspectives that actually came through. I learned a lot from all three of you, and I'm sure the audience will have their own takeaways as well. So thank you very much for your time. It's a real pleasure to having you here. I hope you will see, some traction from the room over here in the next 2-3 years, because, long term may continue to happen. We need to focus on the medium term, short term as well. Thank you very much.
Thank you, panelists. I would like to thank all the panelists for sharing your vision and deep insights. It surely has added immense value to the discussions on the topic. We'll have a group photo. Also, may I now call upon Shri Arora to hand over the memento to our panelist and the moderator. Thank you all. Thank you, Arora sir. Thank you. Thank you.
That was the greenwashing.